to Nirmal, ladies and gentlemen. I'm Hiral Dadia. We have with us Mr. Ananth Narayan, Professor of Finance at SPJMIR, joining in. Welcome to the show, Ananth, and it's always a pleasure to speak to you, get insights from you as to what's in store for us as well as economies across. Ananth, my first question coming to you is, everyone is talking of a recession with regards to where the US goes. The way the Fed has been increasing rates to contain inflation, where inflation is one of the major concerns. How do you see all of this panning out and impacting emerging markets like India?
First of all, thank you so much for having me. It's always a pleasure to be with you. And you're right, you hit the nail on the head. It all starts with the global context. And yes, the market is abuzz with the possibility of a recession in the US. In fact, the first quarter was already a negative growth. This quarter now is expected to be a negative growth as well. So technically, you tick the box of a recession. Having said that, I think it's important to understand the overall context. The US is actually in a good spot. Underemployment and unemployment in the US is at very close to all-time lows. There is no dearth of jobs as of now in the US. Yes, with the recession, you might see unemployment tick up, but it's still very, very manageable. Sure, there is inflation, and inflation not seen for the last 40 years. But you look at the real GDP, which is adjusted for inflation, it's almost back to the path that it was in before the pandemic hit. So they've actually managed to make up all the lost output and more through the pandemic. So overall, the US is in a good spot. What you're seeing right now is the Federal Reserve and the politicians, for that matter, all coming together to try and bring down inflation. Clearly, there is consensus in the US that you have to bring down inflation, and that's what the Federal Reserve is doing. 75 basis point hike the last time. The next one could also be a 75 basis point hike. So this is kind of triggering, call it a soft, call it a hard landing, but trying to get a grip on inflation. In the long run, I don't think that's such a bad thing. I think controlling inflation will be good for the world as a whole. Plus, a lot of other things will also hopefully settle down. You're seeing commodity prices over the last few days come down. China, hopefully this COVID scare will all go behind us. Once the politics out there kind of settles down, you will hopefully see the supply chains coming back. So things could get back into a much more even keel. It could be more a softer landing rather than a harder landing. So in a sense, what you're seeing right now is not a bad thing for either the US or the globe. Your second question on what it means for emerging markets. Look, clearly emerging markets saw a lot of inflows coming in because the US was printing tons of money. There was a lot of fiscal spending. People were given checks. The central bank, the Federal Reserve, purchased a lot of bonds and funded the government. So that money creation spilled over to all emerging markets as well. Look at our own stock markets. They are far higher than where they were pre-COVID levels, right? So despite the fact that our GDP has not grown at all. So it's been a function of flows coming in. Some of those flows will go back as the US adjusts. So that's again normal. It's nothing to panic about. RBI purchased $210 billion over the last 3 years. If it has to sell $60-70 billion in a year, it's not the end of the world. I think eventually it all boils down to us individually. I think India has a good story. There is China plus one. We have an investment plan. We have an aspiring population that wants to hopefully create jobs and output. If things go well, and it's a big if, execution risk is very large, I think we can benefit over the long run as the markets settle down.
Right. So Ananth, would it be right to say that what everyone is talking about, US recessionary fears, is something which could be abated and it's nothing major to worry about right now? It's just the optics that are giving us that kind of a view.
I wouldn't recommend complacency, Hiral. The reality is, this is uncharted territory. We did not see the level of monetization that happened through COVID anytime in the past. So we are in kind of a large experiment mode. And there are also lots of imponderables on geopolitics, Russia, Ukraine, US, China. We don't know how these things will pan out. But if you keep aside all of these recognized uncertainties, the fact is that what the US is doing right now from a policy perspective is right. They're trying to control inflation. They're trying to bring back inflation expectations to an even keel, which in the long run is good for the world as a whole. Yes, we will go through pain. Now, is it possible that we see a hard landing as opposed to a soft landing? You cannot deny that possibility. So if geopolitics and commodity prices remains elevated, as they did in the 70s, we could see a really hard landing. I'm hoping that's not the case, though. I'm hoping the base case is that we manage a softish, hardish landing. It is just a normalization of what was very, very loose monetary policy, fiscal policy of the past, and then things get back to an even keel, hopefully 1 or 2 years down the road.
Right. And with all of this said and done, how are you viewing India as well? We are on a rate increase spree. We've already seen around 90 basis points that have come in. What's the anticipation on that front, and how do you think we are going to take it? And to add to that, do you think that's something which could hurt credit growth?
Great. So why don't I give you my little 2 bits on India's macroeconomy, and then we'll come to monetary policy and growth. As of now, it looks like inflation for this year will be at the RBI's estimate of 6.7%. Earlier, I was worried it might cross 7%, but with commodity prices coming down, it looks like 6.7% that RBI has factored in should be manageable. We should be able to reach it. On growth, there are lots of positives. So services, for instance, is coming back in a very, very strong way post the pandemic. We're seeing the formal sector do remarkably well. Look at the results of all the listed companies. Your Nifty earnings are like 40% plus over 2 years pre-COVID. Over 3,000 listed companies, profits have more than tripled since the COVID times to now. So the formal sector is doing remarkably well, right? As I mentioned, the commodity prices hopefully will come down as the futures market tend to suggest. Normalization is also helping in terms of greater tax revenues for the government, so that the fiscal space is looking reasonably manageable as well. So there are a bunch of positives. There are some negatives as well, right? The first negative to me is that we seem to be struggling to create jobs. The CMI data, you can choose to like it, not like it, but it suggests that we've really not created jobs over the last 5-6 years. And it's not just because of the pandemic. It also suggests that especially in non-agricultural jobs, there is hardly any growth at a time when our young population is asking for more and more jobs. So there's a big, big underemployment in this country, which seems to suggest there is a booming formal sector, maybe the top 15% of the economy, and there's a real struggling bottom 40% of the economy. This should not matter for us in markets. Equity markets track the formal economy, but having this kind of a mismatch and having this kind of an inequity is not good for the medium to long run. We need to create jobs. Second, related to that, Hiral, we have struggled to manage to produce things in this country. Even today, if you look at our trade deficit, it is dominated by things we should be producing ourselves: fertilizers, chemicals, electronics, plastics, toys, a whole bunch of machinery and intermediate goods, all of which we seem to be importing from China and others. We should be creating jobs and producing them ourselves. Now, the good news is we do seem to have a plan to do all of that over the long term, right? So there is, PLI, production-linked incentives, there is infrastructure investments, there is trying to improve ease of doing business, trying to privatize. But again, the execution risks are very, very large. If I was to put this together, what does it mean for monetary policy? Look, I'm hoping that RBI will not have to, and MPC will not have to hike rates as much as the markets seem to be expecting. So markets are expecting a rate hike of, repo rate up to 6.75 to 7% in a 1 year's time. It's currently at, 4.9%. So they're expecting a series of rate hikes even today. I'm hoping that will not be required. I'm hoping the terminal rate can stop at about 5.5 to 6, around 5.75 or so, which will be good news for our borrowers. It will be good news for our banks, and it will be good news for the entire economy, right? Hopefully it will behave itself. What does it mean for currency markets? It's a tricky question. We are seeing net outflows at this point in time. So the rupee is on a weakening trend. A lot depends on the RBI, because RBI has been controlling the pace of depreciation. If commodity markets, adjust back to more regular levels, as the futures market seem to suggest, we should be fine. We should see a gentle depreciation of the rupee. However, if energy prices remain above $100 a barrel for the next 2 or 3 years, then we could see a crisis develop slowly over time. So it depends a lot upon how the global market develops and how we respond in terms of creating jobs and output within our economy.
So I'm saying basically with all of this that we're talking about right now, the key area from here in terms of corrective measures that we need to look at is, how does the economy, how does the government support in creating jobs, not in the top 15%, but in the lower brackets, because that is something which will actually give us a direction. Simultaneously, if you see in terms of the other markets as well, we are talking of inflationary concerns. We're talking of, how the MPC could react from here on as well. But if you see the dollar index, the kind of up move the dollar has taken, it's really standing tall right now. What's that indication that you're picking up on that front?
Again, great question here. Also, look, yes, you're absolutely right. The dollar index is at 20-year plus highs. We've not seen levels of this for a long, long time. I think it's reflective of a few things. One is the fact that there is complete policy consensus in the US that inflation has to be controlled. There is no doubt, and yesterday the FOMC minutes came out as well. It was very, very clear that they are focused on withdrawal of monetary accommodation and rate hikes such that inflation expectations are brought down. Now, if you compare this with the rest of the world, in decreasing order, Europe, Japan, China are not that hawkish at all. In fact, Japan is not hawkish at all. China is, in fact, going on the other side. They're worried about growth not being enough. So amongst all economies, the US stands out as being the one which is normalizing monetary policy the fastest and seems most resolved to do that. When you see that happening, generally money does flow back into the US markets because you're getting better yields in the US. There is more credibility around inflation in the US in this future, and therefore money goes back. Okay, so that's one point. The second is we are seeing a very uncertain time geopolitically speaking. We've seen, and unfortunately, we don't know how things will pan out. I suspect geopolitics is going to be extremely important over the next 3, 4, 5 years. But the point is, when you see geopolitical issues, there is again a flight to quality and a flight to safety, and US markets tends to be the first port of call whenever that tends to happen. So we are seeing a combination of that come through and dollar strength resulting at this point in time. Look, the point is, Hiral, everything that we discussed, commodity prices, geopolitics, federal rate, rate hikes, central bank rate hikes globally, dollar strength, much of this is outside of our control. We really can't do much about it. We are price takers in that sense, and we have to react to whatever happens globally. What is within our control is what you mentioned first, which is how do we respond to this current context? In a funny way, this presents us with a very good opportunity at this point in time. I speak to global investors, Viral. Many of them are looking for alternatives outside of China. The dependence on China for their supply chains and for their investment opportunities has been very large. And many of them have got hurt over the last couple of years through this process. So in a sense, China is doing all the hard work for us, pushing people away from China into other emerging markets, including people like us. Now, that China plus one is a huge opportunity for us to milk, both in terms of strategic relationships as well as in terms of investments. And as I mentioned, things like production linked incentives, your labor or reforms, your tax reforms, your privatization, infrastructure investments, all of this are the steps in the right direction. However, I'm not holding my breath that things will be all hunky-dory. We have been terrible at implementation in the past. We've come out with very nice schemes, but done a terrible job of implementing them. Also, the problems are also quite large. We still have issues around court cases and contract enforcement, for instance. Land acquisition for any setting up a factory, let's say a Boeing or an AT&T wants to set up a factory, it will take them 5 years to acquire land of meaningful size for them to set up a factory. So there are lots of issues which come in the way of all these nice things happening, but I'm reasonably positive that we have a good opportunity. Even if 50% of our plans go through the right way, what is in our control, we can create jobs and output. To your point about you made a good point about creating jobs for the bottom 40%. It's very difficult for the government, to be fair to them, to create jobs at that level. And you don't want Narega type jobs. You want jobs which give out good output, right? What they can do though is what we did for the auto sector. Because you got a Maruti Udyog, you built an ecosystem of MSMEs which supported the auto industry through ancillaries and so on and so forth. Which is what you need. You need large companies to be set up, which then spawns its own ecosystem of supply chains and vendors, which builds the MSMEs, which is what exactly we need for creating jobs. It's going to be a long haul, Hiral, but I think the opportunity is good for us. Of course, there are lots of out of syllabus things in the global markets which can hurt us, but it's our opportunity to grab in our domestic markets.
Absolutely. And I think one of the biggest gaps that we are seeing on the employment front right now is a gap in terms of skilled labor force. I think that's the gap that the government actually needs to step in and fill in, as to how do you empower the youth of today to be skilled for jobs of the 21st century. And if that does not happen, that's the track that the economy needs to take as well. What would you say?
I completely agree with you, Mira. So I don't know how much more I could agree with you. So as of now, it seems to be a two-speed economy. It's a tale of two cities. It's the best of times and it's the worst of times. For the top 15% formal sector, there is a desperate shortage of labor, right? Okay. If you try to hire people in your company, or if you try to hire people in a bank or an IT company or a pharma company, there is simply no skilled labor available. In fact, salaries are going through the roof for that particular sector. So if you look at that sector, you will wonder where the hell is the problem on employment, right? At the same time, the jobs data for the informal sector and the MSME seems to suggest there is a desperate problem of underemployment, particularly amongst women, when it comes to the lower strata of the economy, the not so well off economy. Now, how do we bridge this gap? You're absolutely right. Skilling is required. Along with land acquisition that I mentioned, skilling is definitely a problem. But more medium term, Hiral, this cannot be resolved overnight. Eventually, we need investments into education, healthcare, sanitation, public services, which will allow our children to grow into strong, future citizens who can manage whatever the economy throws at them and grow, right? In that respect, unfortunately, we've not done a great job. Some of the statistics that the National Health and Family Survey shows is terrible. 35% of our children are stunted, which means this is ages 0 to 5. They are far lower in terms of height than they ought to be. 18% are wasted. Now, the point is, if a child is in the age of 0 to 5 is not getting enough nutrition and has not grown adequately, her brain will not develop, and her chance of doing a CA or going to IIT or doing an MBA is very, very low. We need to resolve these basic things. As an investment, there is no shortcut for this. You have to do it over 10 years. Every large country which grew, Malaysia, Thailand, China, all of them did so by investing in their children over a couple of decades, which is something that we need to adopt as well. But I'm positive, Hiral. I think the opportunity is there for us. I think people recognize it. The good thing is we have good people, good entrepreneurs, good workers. We will grow despite whatever the policy context is. With a bit of help, I think we can grow a lot faster.
Absolutely. And I think it's Education 4.0, which will be able to help us enable Industry 4.0. That's what I'm going with, where that match needs to happen. Very lastly, Ananth, overall, if you see in terms of the fiscal side of it as well, how are you looking at it? See, the government is pretty sure of what they want to do in terms of FY23 on the borrowing front, on the fiscal front. Do you think that's a realistic number, or do you think we will see major tweaks coming in there?
Sure. Before I answer, Hiral, I'm going to copy your line shamelessly. Education 4.0 is a precursor to a required for Industry 4.0. Completely agree. On the fiscal side, I think the news is reasonably positive. Okay. The point is the following. One is the budget estimates for revenue collections, etc., were very, very conservative. We know they're going to collect a lot more than what they've budgeted, despite the cuts done in excise duties, etc., etc. I expect 2 lakh crores more of revenues to come through purely from the fact that the actual growth in nominal GDP will be far higher than what the budget document suggested. Last week, we also had those windfall taxes being collected, which again should help on the fiscal front. Yes, we've had a lot more of expenses as well. So we've had food bill, which is free food being given, food grains being given till September. Fertilizer bill has gone up, subsidy bill has gone up, power subsidy bill will probably go up as well. So there are multiple costs as well. But I think at New Delhi, there is a broad understanding that we have to remain fiscally prudent. I think they will adhere to this overall 6.4, 6.5% kind of fiscal deficit for this year at the central level. There are problems at the state level, but I think that also can be managed on the back of an economy, the formal sector doing far better than we expected. Plus, I think there is room on the borrowing program here. So last year, at the budget level, the central government had estimated that they would have to borrow 9.7 lakh crores in the market. The actual borrowing was just 8.1 lakh crores. And the reason for that is they got far more borrowings through the small savings schemes, and they got money from other sources as well. So I suspect even this year, despite all the fiscal problems and excess spending, the final borrowing program for the government might actually end up lower than what the budget was at 11.5 lakh crores.
Okay.
So on the fiscal side, I'm reasonably positive. Of course, all this will go out of the window if oil prices go back to $150 or something. Then every calculation goes out of the window. But as things stand today, I think on the fiscal front, the government will do a decent job. They will collect more revenues than budgeted. They will cut down on non-productive expenditure, and they will have these windfall taxes, which they will use to ease inflation with these excise duties, etc., to increase capital expenditures and to reduce the borrowing.
Right. So very lastly, Ananth, on the 10-year bond deals as well as the rupee, you've seen the 10 years drop to its lowest level in 6 weeks. Rupee has remained near record lows as well on the back of the global recessionary fears. But what's that kind of equation? Because everyone's talking about at least consolidating at 80 to the dollar. Is that a number that we should be working with? Or do you think we will improve further then?
On rupee, Hiral, I think we will depreciate slowly over time. It will be controlled by the RBI, but I think it's in the sense that it looks inevitable unless oil prices come down to $60, $70 a barrel. And the reason is very straightforward. At the moment, our current account deficit for this fiscal year looks like about $100 billion.
Right.
We could see FDI of about $45 billion net. That will leave us with an outflow of $55 billion. Already, FPI outflows in equity have been $14 billion this fiscal year. So we've already seen 55 plus, prospects of $69, $70 billion worth of net outflows for the year. Now, RBI will have to sell large amount of dollars to protect that. But given what you mentioned about global dollar strength, rupee is actually doing much better than other currencies like euro, sterling, yen, etc. That's not good for us in terms of trade competitiveness. We are effectively strengthening against those currencies, which is not at a time when you want to create jobs and output in this country. So over time, weakening the rupee is not a bad thing. We have this mental block about 80 rupees to a dollar, etc. I'm sure lots of WhatsApp messages will go when that happens. But the point is, it's not a bad thing. It's adjusting to what's happening globally, and it's good for us and our own jobs and output prospects if that were to happen. So I do look at rupee as gentle depreciation. By the way, if oil prices were to go very high, $120, $130 a barrel, we could see even greater pressure over 2-3 years. On the flip side, if oil comes down to $75 a barrel, as the futures seem to indicate in 2-3 years' time, then things will again adjust back to a normal even keel. On the bond front, look, I'm hoping that inflation will peak around August, September at close to about 8%. It might go up to 8%, by the way. Thereafter, it should start to come down. I'm hoping, therefore, that the RBI can stop at a terminal rate of 5.75 or 6. Over time, I think inflation, hopefully, as long as commodity prices behave themselves, will remain under control, which means anything above 7.5% on 10-year bond yields is attractive from a return perspective. If you think your medium-term inflation will not cross 6%, it's a good level to look at. Does it mean you and I need to jump in and start buying bonds? Not necessarily. On a tax-adjusted basis, unfortunately, the return you get on fixed income is quite low, especially for tax-paying folks. But I would think anywhere between 7.5 to 7.75 would present levels for buying of bonds and getting into fixed income, especially if your prospects of inflation look controlled over a medium term.
Right. So I think that's key that we should be watching out for as well. But a great conversation, Ananth. Overall in terms of, it's more of a realistic conversation that we've had as to what could be expected. But thank you so much for being on the show. Always a pleasure to speak to you. Stay safe and speak to you soon again.
Stay safe, Hiral, and thank you very much for having me.
Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.